Week 7, Biz 630, strategies that drive capital decision making for the week of March 14th to March 20th. Concluding this week on Sunday, March 20th, you have case number 4, which is a financial statement analysis of one of the companies you selected this session. And you are to do a PowerPoint presentation or a PowerPoint format of the answers of that case. There's a sample format, and we'll go over that case number 4 in just a few minutes. Our main topic this week is talking about mergers and acquisitions, friendly mergers, hostile mergers, horizontal acquisitions, vertical acquisitions, all different strategies that drive capital decision making. Companies need capital. They don't have enough credit, they don't have enough growth to satisfy investors, so they merge or they acquire other ways of getting capital for future growth and investment. And we'll talk about that this week. But first, a video going over the basics of this.
Mergers and acquisitions, or M&A, refer to the consolidation of companies through various types of financial transactions. Although they're often used interchangeably, they mean slightly different things. A merger occurs when two companies combine to create one organization. For example, Exxon and Mobil merged in 1999 to form a new company, ExxonMobil. An acquisition, on the other hand, refers to the purchase of one company by another where the purchasing company obtains majority ownership in the target company. For example, Amazon acquired Whole Foods in 2017, but both companies preserved their names and organizational structures after the deal was finalized. Over the last century, there have been multiple waves of M&A activity in the U.S. The recipe for M&A usually involves cash-heavy companies and low interest rates, allowing companies to more easily pay for deals. Also, when demand for their goods and services is slow, companies might look to grow through M&A rather than organically. Conversely, high interest rates and an unfriendly regulatory environment have the potential to slow down M&A activity. Companies do M&As for a number of reasons: to increase performance, decrease costs, diversify their business, or to grow market share by buying a competitor. Do all mergers and acquisitions work out for the best? Not quite. In 2001, America Online combined with Time Warner in a massive $165 billion merger. The new company, AOL Time Warner, sought to capitalize on the convergence of mass media and the internet. Shortly after the merger, the dot-com bubble burst, causing the company's AOL division to lose significant value. In 2002, the company reported a massive loss of $99 billion. In an acquisition, once plans are made public, the acquiring company's stock price typically declines, while the target company's stock price often rises near the expected deal price. But this isn't always the case. When Amazon agreed to buy Whole Foods for $42 per share, Whole Foods jumped from $33 to $42, gaining more than $9. Amazon's stock also gained, opening $32 higher. As a shareholder, the decision to hold or sell a stock before a deal is final can be tricky. It's always possible that the deal may fall through, likely erasing any gains. However, other companies may jump in and bid a higher price for the target company. This may result in a bidding war and drive the stock's price even higher. So what happens if you own stock in a company being acquired? You could receive cash for your stock, a combination of cash and stock, or another form of compensation. It's important to note that every deal is different. Be sure to check the investor relations page of both companies and contact your broker with any questions. With any trade, there are always inherent risks. Trading companies involved in mergers and acquisitions could result in a substantial profit or a substantial loss in a short time frame. Make sure you do your research and assess risk before making a decision.
This video segment discusses mergers and acquisitions in the context of strategic management. Merger and acquisition activity is extremely important in strategic management as we continue to see larger and larger deals in front of us. One of the more recent in the acquisition area is that of Google's proposed acquisition of the Motorola cell phone business for $12.5 billion. This signals Google's desire to further diversify away from its search engine business into an area it thinks has great potential for profits. It's instructive to differentiate between merger and acquisitions because they are quite different. In a merger, what you'll have is two firms of somewhat similar size that just combine their assets, and their names typically become combined as well. You may recall the failed merger some dozen years ago between Daimler and Chrysler. Their names became merged. Acquisitions are quite different. This is a situation where you find a larger or more cash-rich firm buying a smaller organization. The smaller organization then comes the subsidiary of the larger organization. If the Motorola acquisition goes through, Motorola will become a subsidiary of Google. In the not too distant past, Kraft paid $20 billion to purchase Cadbury. Kraft is a United States convenience food manufacturer, and Cadbury is a confectioner into chocolates and chewing gum, and they are located in the United Kingdom. Kraft paid almost $20 billion to purchase all the assets of Cadbury. In the business press, we quite often see merger and acquisition activity discussed interchangeably, but these terms mean something very different, as you can see from this and from this slide as well. In the situation of mergers, you have a situation where either the names become combined or one of the parents may become the dominant player, and they're simply named after the larger or the more dominant organization which comes through in a merger. One of the parents, regardless of how their name changes or does not change, usually emerges as the dominant management team. I don't know what the case in Sirius XM radio is, but I do know that Daimler, a German company, became the dominant management team of Daimler Chrysler some years ago. In acquisitions, you have a situation where the acquirer, which was Kraft Foods in this case of Cadbury, just buys out all of the firm's stock. So they bought all of Cadbury stock for nearly $20 billion. And these types of activities can be either friendly or hostile for the acquiree. There are several types of merger and acquisition activity, and I'm going to detail 5. Vertical activity in mergers and acquisitions could be simply to buy a supplier or customer. So they're vertically going forward or backward to streamline their cost structure. And Johnson & Johnson acquired some time ago Mentor, which is a latex glove company, among other things, to complement its products to become a supplier to other divisions of Johnson & Johnson, hence streamlining its cost structure. In the case of horizontal merger and acquisition activity, we see a situation where you merge or acquire a competitor, and we've seen that in the recent past in so much as that the Dutch firm InBev bought out Anheuser-Busch, thus reducing their competition to some extent. Product extension is a situation where you're buying complementary products or acquiring them to fit your portfolio, and in this case Kraft's acquisition of Cadbury is a perfect example of complementary products. It also exemplifies market extension, which is where you want to go into different markets. If you studied the Cadbury Kraft acquisition, probably the main reason that Kraft wanted Cadbury so badly is that Cadbury does very, very well in some emerging markets where Kraft does not do very well. And namely, those two markets are India and Brazil. Cadbury does very, very well there. Kraft has had minimal success and hopes to piggyback off Cadbury's leverage in those two large emerging economies for Kraft to do well. And that's market extension. And then there's also this unrelated firm of merger and acquisition activity. We call it conglomerate merger and acquisition activity. And this is a constant strategy that General Electric undergoes. General Electric, if you look at their web page or their annual report, they are into a wide host of products, from light bulbs to appliances to jet engines to medical imaging products in the healthcare industry, and many more industries as well. So it buys firms that are quite different, but at the same time it diversifies their total risk by being involved in a lot of different industries. The logic behind this related merger and acquisition activity, when you buy something that's related or you merge two firms that are related, what you hope is that you have value creation. And that is what's hoped from the merger between Sirius and XM. They need to create value because both firms were losing money. And we examine this when talking about the value chain. Part of that value creation is going to come from cost reductions, hopefully through economies of scale, or a larger new satellite radio organization being the new merged company. And also another value creating activity we see called economies of scope, and that is situations where firms can share competencies. And really this goes back to the value chain as well. They can share branding, name, content, subscribers, etc. There are some implementation issues in mergers and acquisition activity. No better illustrated than in the case of Daimler and Chrysler. And that's in cultural differences. A German organization merging with a US organization. Merger and acquisition activity always requires the merging of two different cultures, whether they be from two different countries or from the same country. You're still going to have two different and often quite disparate organizational cultures. That was a big problem for Daimler and Chrysler. Cultural merging involves a number of things. Among other things, it involves the combination of elements of two different cultures, management styles, products, customers, etc. It's interesting to see what's going to happen if the Google acquisition of Motorola happens and the Kraft acquisition of Cadbury, as of this speaking of late 2011, is already complete, and we still have not seen yet the full effect of the combination of both cultures. We do know in the case of Kraft that Cadbury has fought this over in the United Kingdom because they're not happy about an American company buying out their company, and many are unsure about their stability as an organization going forward, thinking Kraft might take the chocolate company and move it back to the United States. So it's difficult, costly, and it's not always possible to pull off a merger and acquisition from the implementation side. One last thing I'll say is that merger and acquisition activity is kind of risky, but it's especially risky in the international side. Research shows that 70% of all mergers or acquisitions that take place between firms from different countries are going to fail. So if you think about that, your odds of making a merger or acquisition work when you have headquarters from two separate countries, your odds are not very good.
Okay, two good, short but sweet videos explaining mergers and acquisitions and the different types that there are. And it gets quite confusing if you think about it, of all the different varieties, but it's fairly simple. It's basically a company needs capital. They've run out of resources for that capital, so they seek to go out and find that capital by either merging or acquiring other companies. Now, the complications exist when you have to find the deal that satisfied both investors and both companies, and that can get complicated. A couple things I want to show you in the Blackboard. First of all, in week 7, there's a couple of articles here, and I want you to note these two articles, but you don't have to read them until next week. They're week 8 closing articles, closing discussions of our course, and they kind of lead into one last little bit of strategic advice when it comes to the electrics case. Now, remember, we have an electrics case review session this Saturday, where the main discussion by me, besides answering your questions, is to go over the paper, the writing and answering of those questions in the case analysis. In addition, we have office hours, student hours on Thursday night for any review. And also in my Friday weekend video, I will have further analysis of our checklist and other items relating to the spreadsheet of the electrics case. Also, this week, we have case number 4. Case number 4 is posted in Blackboard. And there's a little bit different format to the case this week because you're going to be doing a PowerPoint presentation. Now, you're not going to be presenting that PowerPoint to the class. You're just going to be doing the file and giving it to me. And I've supplied you a sample PowerPoint format, and I'll take a look at that in a minute, so you can just kind of get an idea what I'm looking for. And you can be your own personal colors and way you like doing things involved in this, but I wanted to give you the basic format of the PowerPoint. And again, you do not have to present it to me. It's just giving me the file and I'll be reviewing it like you will be presenting it in front of an audience. Also, it involves the company that you have selected way back in the beginning of this course and doing some more work on that company in regards to financial statement analysis. So here are the key parts of this case number 4. First of all, case number 4 is entitled Financial Statement Interpretation and Ratio Analysis. So let's say in terms of the chronological order of our course, you've done a credit analysis, a risk analysis of your company. We've looked at a capital budget analysis in a spreadsheet format of not your company, but a specific example. And now we're taking a look at the financial statements. In other words, the returns are the statements that show us whether these investments in a variety of assets have been profitable, have provided the necessary return to these specific real world companies that you have selected. And I want you to take one analytical equation from 4 sections of financial analysis: profitability, asset management, liquidity, and debt management. Now, these 4 areas of financial management and statement analysis are given in this PDF that I have supplied along with the other files and data for case number 4. You are to pick one equation from the profitability section, from the asset management section, from the liquidity section, and from the debt management section. You pick. Here's the examples of that. Here is the equations for that. And you'll have to do a little bit of research about what whatever equation you selected explains about the company. So just one. So you're going to have 4 analytical equations for the quarters ending 12/31/21 and 12/31/20. So you're going to have 4 analysis for 2 quarters: one 12/31/21, one 12/31/20, and do an analysis of what that information tells you in regards to profitability, asset management, liquidity, and debt management. You're again reviewing the financial statement information. Now, your analysis should answer or interpret the following things. Has the firm or company you selected improved its performance from 2020 to 2021? Is the firm managed efficiently? It's a bad word there, efficiency. Is there efficiency in the management of your company? And as a potential investor, would you consider the stock as a buy for this company? And in relation to that, I give you this. Case 4 is a financial statement analysis of the company selected at the beginning of our spring session. Structurally, the students will present the case as follows. The student will identify which ratios, remember 4 per section, per 4 ratios, 1 per section, there's 4 sections. Each ratio class must be presented as part of the case. A ratio analysis should require 2 quarters: December 31st, 2021, December 31st, 2020, quarters. The trend in order to adequately develop performance patterns. The financial statements to be source of the ratio calculation should be from 10K filings. Now, 10K filings opens the world up. You could use the information in Yahoo Finance. You could use the information from the D&B database at the Wilson Library. You can use information from the actual company. Your source of information just has to tell me where you got the data to do your analysis. If industry standards are available, they can also be presented as a complement to the analysis. You show the 2 quarters, but also show what the industry average is of those quarters and add that to your analysis. Now that is not a have to. That is just only if you get that information available and include it in your analysis. You don't have to do that. Comparison to industry average should never be the primary measurement of relative performance or primary focus of your presentation, or the main focus is within the company for those 2 quarter time periods. The use of charts, graphs, tables are strongly encouraged to present the data for analysis. Finally, within each class, a conclusion on overall financial performance will be presented. The student will then present an overall conclusion based solely on the overall financial performance presented, on the relative strength of the company. Finally, based solely on the financial performance of the company as presented in the ratio analysis, the student will recommend selling, hold, or buy stock of the company and whether this company is managed efficiently. Here's the format example of case number 4 that I'm providing you in the case. It's kind of a synopsis of this case in a PowerPoint format style. You have your opening slide. You have your agenda, just like you're giving a presentation, but you're not giving a presentation. What's your agenda? What are you trying to show? Again, the company here is the Home Depot. Financial analysis, efficiency, potential investor analysis. That's what you're trying to do in this presentation. 4 sections of, in this case, this is an example of United Healthcare. 4 sections of financial analysis for quarters ended December 31st, 21 and 20. You're choosing from liquidity, asset management, debt management, and profitability, as we discussed earlier. And then you provide the analysis, the 2 different ratios, the 2 different the analysis from each of those sections. So you're giving 4. Notice how I did this is for the current ratio. I define what the current ratio is, and then I give the data analytical information from this company. Now here the years are a little bit different, but you get the next 2 different analysis for 2 different quarters showing what in this case, the current ratio is. And what's your comment on that ratio? The short, sweet, to the point, and easy to read. Asset management. In this case, they pick the asset turnover ratio. Again, they explain what it is, they give the information, and they review what it tells them. Here's debt management, which is debt to assets ratio, total debt divided by total assets. See what you're trying to do? You pick an analysis, you pick an equation from that group that I gave you, you find the data, analyze it, and show what it is. Very quick and concise. And finally, the profitability ratio. In this case, return on assets, and what it is, explain it, and the data for those particular time periods. And then finally, your interpretation and review in one slide. Has the firm improved from the previous year? Is the firm managed efficiently? As a potential investor, would you consider the stock? Bingo, bingo, bingo. Quick, concise, just like you're giving a presentation. I can read it quickly. There's not a lot of busyness in these slides. It gives me the information and we move on. I think this is a great example and format of this analysis. And then don't forget your reference sections. So I think that's a good analysis of the case and a good example of what I'm looking for from your particular company that you have selected. Here's the rubric for this case. How I'll be grading it: 33% from your use of data. Your data research, is the data accurate for those 2 time periods, December 31st, 21 and 20. A third for analysis interpretation, bullet points, interpreting the data, giving the data, and 33% on the case format, presentation, grammar. Is it clarity? Is it concise? Not very busy. I can look at it and see what I need to find out from your analysis of this company. Use that format. That's a perfect example of what I'm looking for. I Be short, concise, find the data, not too much other than that. That's what I'm looking for, part of the research and interpretation of the financial performance of your company that you have selected this period. There's the rubric, and that's how I will be grading it for this casework, which is due next Sunday. Again, you got a lot going on this week and next. You have the electrics court case, which I know you hopefully are beginning to work on and maybe even finalizing the spreadsheet analysis. You have this PowerPoint, and some of us maybe not have much expertise in PowerPoint work. That's why I've given you a format. You can use that as your template if you don't have much expertise in that. But I want a PowerPoint file posted to Blackboard by next Sunday night. If you need an extensions are available, but no PDF, no Word documents, just one file, PowerPoint. And finally, remember in week 7 this week, you have a couple of articles listed there. That one article of measures that drive performance, and one article strategy without disrupting your organization. That's a good one. And I think a lot of you could probably relate to that one from your own business companies and careers. Those articles need to be read for next week. You do not have to read them this week. They don't have anything to do with case number 4. They just are a good basis for some additional discussions next week leading up to the conclusion of our class with the electrics case. Again, remember, I will have a video for you on Friday, and I guarantee Friday because, again, we have a review session Saturday morning at 10 o'clock. The link is in a variety of places, but here's one right under Zoom and YouTube links. There's the link Saturday morning at 10 a.m. If you can, I'll be recording it if you cannot make it. If you cannot make it and have specific questions about the electrics case, email them to me in advance and I will answer them during that review session Saturday morning. But again, that session will be recorded and I will be going over specifically the paper aspect of this case analysis. But I will answer questions concerning the spreadsheet work as well. So that's our work for our beginning work for this week number 7 this week. Have a great week and I'll see you down the line. And remember, we have a review session Thursday night via Zoom. Have a great week, everybody. One more week after this and we're all done. Adios.